Hey, good morning, options traders, and happy Wednesday. Happy hump day to everyone. And I've got another really cool topic, really good question for the group. And that is for all of you vertical spread traders out there, should you hold vertical spreads for their maximum value? And this came up in a conversation with a trader the other day. And what he was saying is that as soon as my spread makes money, especially because it looks great in percentage terms, I like to cut it, take the for sure profit, and then move on to another one. Well, that always sounds appealing, but we have to understand there's always a trade off and there's a very big risk for doing that. What's the cost of not letting your spreads run to full value? Let's go find out more. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So, quick refresher for everybody who might be new, vertical spreads. It's a strategy where you're going to buy an option. I'm just going to use calls. Let's say you buy the October 100 call, maybe you spend 5 for it, but now you're going to sell an option against it. So maybe you sell the October 105 call and collect 3. So in the business, we just say that this would be executed for a net debit. You're spending 5, collecting 3, it would be $2. So one of the first things to notice is that if you bought this call by itself and spent 5, your expiration break even is 105, 100 strike plus the $5 cost. If you buy the spread for 2, now we need the stock to be at 100 plus 2 or 102 just to break even. So this area between 102 and 105, the break even for just the long call, becomes profitable for the spread, but not for the call. So spreads do have this extra little area in there where they can be profitable. So we should expect to see a higher percentage of profitable trades from our vertical spreads. Also, because they cost less, we should have a more consistent return because we're going to have fewer losses. We're going to have a smaller standard deviation in statistical terms. So let's go see some visuals about this. Now, we've seen this graph before. This is a simulation of a $100 stock over 250 trading days, or roughly a year. And let's look at the prices, let's say, between 100 and 105. Those are the 2 strikes that we just saw. So if we were to mark the finishing stock prices out here, let's say after a year, in very small buckets, maybe 5 cents wide, so maybe $100 and 100.05, and 100.05 and 100.10. How many times did the stock price land in those little buckets? And if we were to measure them, we would get a bell curve. Now let's go mark off the 100 strike and the 105 strike that we saw in the previous slide. And the thing to notice is that the area here between these dotted lines is very small compared to the area up here in the right tail, the higher prices, and here in the left tail for the lower prices. So think of those strikes like goalposts in a football game. Where is the stock more likely to land? Between the strikes in this little area right here, or above them, or below them? Well, it should be obvious that it's far more likely to land above or below. And so this is one of the first drawbacks if you're closing your spread when the stock is between the strikes. Now, obviously, you're going to get a much bigger magnification out here after a year. Very few people are doing 1-year spreads. But if we come in here, let's say to 30 days, our bell curve just gets a little taller and skinnier. So this area between the strikes becomes relatively bigger. But there's still a lot of area outside of these strikes, whether above or below. And so again, no matter what time frame you're using, if you're closing your spreads with the stock between the strikes, you're missing out on these very potentially big returns. So the question becomes, how often is that going to happen? How often will the stock price get out here into this upper tail or into this lower tail compared to landing between the strikes? Well, that's a really good question. It's going to shed a lot of light on the answer here. And so let's go over to an Excel demonstration and find out more. Okay, so now we're into an Excel spreadsheet, a little simulation sheet that I put together. It's going to take a moment to explain what it is. But up here we have some inputs for a Black-Scholes model, stock price volatility, interest rates, and expiration in years. Anything in red we can change. And then down here we have two different strikes. 100 strike, 105 gives us the Black-Scholes price, and then it's going to give us the price of the vertical spread, which of course is just 378 minus 133. If I change this, let's say to 110, now it's going to show us the 100-110 vertical, which would of course be more expensive at 346. So we can make these things anything we want. And so down below, we're going to run some simulations. I have 1,000 rows, and over here we're going to pick a random number, and that's going to be a seed for a bell curve, and to say, well, based on this time, this current stock price, and this volatility, pick a stock price according to that bell curve. So here it came up with a stock price of 94.39. If you have the 100 call, it's worthless at expiration. The spread would also be worthless at expiration. The call we paid 378 for, so that would be a 378 loss. That's our P&L. The spread we paid 245 for. We'd have a 245 loss. So was the call profitable? It's just saying, is this number in the P&L column greater than 0? If the answer is no, we get a 0. If it is, we get a 1. Same thing here for the spread. If this number is greater than 0, we're going to make this a 1. Say yes, there was some profit to show for it. We're not counting commissions here. We're just saying, was there any profit at all? So let's just start with those inputs, and what are we looking at here? So if we run this simulation 1,000 times, these are the stats that we're getting from it. The call was profitable 414 times, or 41.4%, but the standard deviation was 4.36. Now look at the spread. Spread was profitable 503 times, as expected, should be more, or 50.3% of the time. But look at the standard deviation, much smaller. In fact, just about half of what it was for the long call. So this should also tell us if we're trading spreads, we should expect much more consistent profits, even though they're smaller. Now here's where things really start to get interesting. Let's take a look at this graph over here. These are the payoffs for the call. This is just a histogram showing this first bar here. We had losses between a full loss and maybe down to 228. This bar right here is total losses. Here we have some losses with maybe some small gains. But out here we start getting into some large gains. Out here some very large gains, but they're infrequent. And that's typical for a long call. We have these potentials for very big home runs. They just don't happen that often. And that's what we're seeing here, exactly what we would expect from these simulations. Now, just for a little reality check, in this 1,000 trials here, the simulation, we got 41.4% of the calls were profitable. Here's the actual probability, 41.5%, so just about dead on. And over here is our spread. We would expect 50.4, we got 50.3, so pretty close. But here's where things really start to get interesting, one of the main points of this video. Look at how many times the spread hit maximum gain. The full $5 was almost 34% of the time. It hit a worthless state about the same. It hit between the strikes about the same. They're all roughly a third. So remember, once you're in a shorter time frame, such as within 30 days, that area between the strikes becomes relatively bigger. And here, roughly a third. So what does this mean for the spread traders? Well, let's take a look at the various outcomes that we got in our histogram. Remember, compare this to the long call. And you'll notice something very interesting about vertical spreads. This is another main point of this video. They will always have almost a binary type of outcome. We have a very big bar out here on the left. We get a very big bar out here on the right. So it tells us most of the time we have two values, either a total washout or we hit maximum gain. But relatively speaking, smaller percentages of the time here, we can get somewhere between. So this bar is minus $1.45 to minus 45 cents. That's still a loss. Over here is minus 45 cents to positive 55 cents. The halfway point there is basically zero after commissions. We can forget about that bar. Up here we get 55 cents to $1.55. So the halfway point is roughly $1. That's not so bad after commissions. We can at least make a little bit of money, but not a lot. Over here we make between $1.55 and the maximum of $2.55. It's about 5.7% of the time. But look at this over here. 34% of the time we hit maximum gain. And so if you are closing your spreads between the strikes, what you are necessarily doing is picking up nickels in front of bulldozers. You're picking up these pennies because it feels good, it sounds good to say, let me take this for sure profit and I'll move on to something else. But look what's happening. You're still exposing yourself to these massive bars over here on the left for a total washout. And you're completely erasing this bar over here for your very best gain. So if you consistently do this, close your spreads between the strikes for, let's call it nickels in front of bulldozers, maybe even pennies in front of bulldozers, you're going to end up with long-term losses, even though on paper you're saying, well, I've got a much more consistent strategy and they look great in percentage terms, and I'm greatly limiting my losses because I can only lose, let's say, 245 instead of 378. But the big thing to take from this is that you are chopping off this right bar. And so you're left with battling these losses. Remember, these are actually a total loss here. And then for a very small percentage of the time, picking up nickels. It's just not going to work. Now, let's do a couple more simulations. I'm going to hit F9. Same thing. Still get these big goalposts out here on the far left and far right. Again, vertical spreads are mostly a binary looking type of payoff. It's either going to be maximum loss or maximum gain with some smaller percentages between the strikes. Let's try it again. So you just can't avoid it. Most of the gains come from this far right bar, and you're completely erasing that if you are going to consistently close those spreads here. Now, as we talked about in the presentation, as we go out in time, that area between the strikes becomes much smaller. Now, most people aren't going to do a 1-year vertical spread, but just for the demonstration, let's make this a 1-year time period, and these bars in the middle should just about flatten. So watch this. We'll make that 1 year, and there they go. See, the vast majority of the outcomes are either complete loss or maximum gain. But once again, if you are erasing this bar from your trading strategy and saying, I'm not ever going to allow it to get there because I want to pick up these small gains here, they're going to be very infrequent and very small, but you're still going to be subjected to these large losses. So without getting into the deeper math of it, just think about it. If you are never allowing for this bar to ever appear, and you're only lucky enough once in a while to pick up some nickels in front of bulldozers, but you are always subjected to this bar over here, it's a long-term losing deal. Now, that's not saying you should never close a spread prior to expiration or between the strikes, but it shouldn't be your go-to strategy. That's going to be a losing deal in the long run. So what's another way to understand the cost of closing the spread early? Well, let's take a look at what happens visually over time with our vertical spreads. So here's our 100, 105 vertical. Remember, we get our bends at the strikes. And the blue curve is the current curve. And notice how it's relatively flat, relatively straight. So we don't have a lot of deltas. If the stock is between here, we might have a 50 delta on our long call, very small one out here. So we might have a net 30 or 40 delta out here. It's just not going to be very responsive. So as time passes, this left side sinks down. That's our negative theta, positive gamma area. And again, as time passes, the right side over here is going to move upwards towards the expiration graph. That's our negative gamma, positive theta zone. And so watch what happens. As time passes, that blue line shifts this way, becomes the red. And then it becomes the green. It starts moving slowly towards that black line. And then when you get right up into expiration, you're starting to get lots and lots of curvature. This is the part that you are ignoring when you close the spread early between the strikes. This is the transition from this relatively flat line into this very greatly curved, or the gamma, or the curvature, the convexity of these options. That's what you're paying for. And that's what allows you to potentially propel yourself up to the maximum value, and you're never allowing that to occur. Now, again, that doesn't mean that you should always hold spreads to expiration or to maximum value, especially if the stock is really close to this short strike for this very reason. This negative gamma right here can really come back to bite you. But the point is, it shouldn't be your go-to strategy to close at the first sign of a small profit, even though it might look good in percentage terms. Why? Don't ever forget that vertical spreads have mostly a binary payoff. And when you do that, you are chopping off that very valuable right tail. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.